Last lecture today. Let's zoom in on this little textbook again. Risk management in banking. I'm going to show to you again by Joël Bessy. Here is what it looks. Chapter 60 is called Securitization and Capital Management, beginning from page 7044. And before that, I will begin with that magic Wall Street word called structured finance. Alright, so come on guys, class has begun, please pay attention, alright? You don't have to be here, but you don't need penalties either, okay? So, number one is securitization. So, what I'm beginning to do is a 5-minute elementary introduction to structured finance. Structured finance is classified broadly or falls broadly within four areas. First one is securitization. Second one is called project finance. The third broad area is called asset financing. And the last area is called LBOs, leveraged buyouts. So, basically, project financing is the business of separating out the financing of a whole project all together with its assets into a separate vehicle or a separate business for the purposes of isolating both the assets and liabilities, and therefore isolating the sponsor, that's how it's called, the sponsor of the project. This is typically done in intermediate corporate finance, and you should be taking with Professor Matev in your what you call advanced corporate finance a heavy duty of this stuff. Similarly is with asset financing. Is a remarkably similar concept. The one is a whole project, the other one is an asset. A whole project may be developing a new mine, developing a new oil field, developing some other stuff. What might be an asset? An asset may be as simple as a ship, which could cost hundreds of millions of dollars. An asset financing may be what? An airplane, alright? So, an asset is a much, much narrower concept than a project. A project may involve dozens or hundreds of different assets with their revenue streams. And finally, LBOs, again, is a subject typical in intermediate corporate finance. Leveraged buyout is the process of raising funds, typically privately, through a investment bank or possibly a commercial bank for the purpose of buying out all outstanding publicly traded or exchange traded shares in order to make a public company private. The classic instrument, which I've covered quite a few times, is called a leveraged loan. Leveraged loan. And of course, the leveraged loan may possibly have structures and whatnot. I don't want to get into that. this is something that you're going to be studying elsewhere. So what I do and will do for the rest of this lecture is zoom in on securitization, because securitization was the driver over the last 3, 5, 7 years of the whole structured finance Wall Street thing, which led to the credit crisis and is currently unraveling. So we're moving now to structured finance, chapter 60 of the textbook. I don't plan or intend to do the quantitative stuff and the modeling today. That's not the intention of this course. What you have to do and what my goal is to understand the concept. So first of all is the concept of securitization. And securitization is a technique, an investment technique of selling assets on a balance sheet to outside investors. In other words, it is a technique by which you transfer balance sheet assets off to a separate structure to other outside investors. The second concept is called a structured note. And structured note is the financial instrument which is used to finance, or the other key word is to fund the structure. I'll be explaining also structure soon. Is to finance the structure, in other words, to finance the purchase of these assets. In other words, they are on our balance sheet, we'll sell them to a structure, and that structure will be financed. Someone must pay for it. They pay for it with structured notes. One of the key characteristics of a structure, and of course applies to structured notes, is called seniority rule. Seniority rule relates to the covenant. So here is another key word, covenant. Seniority rule relates to the covenant in which cash flows are distributed throughout the whole structure. So seniority rule relates to a priority given to some structured notes over other structured notes. And I'll be, of course, explaining a whole lot more about it. Some of the popular instruments which I have already covered and will not be explaining today, I've covered in one of our first lectures, are called CDOs, collateralized debt obligations, CMOs, collateralized mortgage obligations, and CLOs, which stand for collateralized loan obligations. Examples of loans will be student loans, credit card loans, auto loans, and even possibly leveraged loans, loans used to finance an LBO, or a package of loans, let's say a dozen different LBOs pooled together in order to diversify LBO risk. I mean, one LBO may have a specific risk, but if you finance 12 or 15 LBOs, you package them together within 15 LBOs, you at least diversify out the idiosyncratic risk. All right, so, and there is that other one which is called synthetic CDOs, which use if you would remember credit derivatives, which is the use of credit derivatives to effectively replicate collateralized or securitized instruments. Alright, the next concept is called non-recourse sale of assets. A recourse sale simply says that when an asset is sold, the buyer may have a recourse back to the seller for maybe the financing, maybe for a bad product or some other stuff. Non-recourse means that the sale is final. Non-recourse means that if whoever bought the asset, of course the asset is always, in this particular case, a financial asset. Whoever bought the financial asset may actually suffer losses, and when they suffer losses, non-recourse sale means they cannot push it back to the seller and ask their money back. In other words, non-recourse sales effectively has the intuitive meaning of non-guaranteed. Non-guaranteed. Because it's a sale, it means non-guaranteed by the seller. By the seller. Now, the next piece, however, within the non-recourse sale or in general is the guarantee. And this is where most of the previous lectures were relevant to structured finance, is that non-guaranteed refers that the seller does not provide guarantee, but it doesn't mean the structured note itself or the instrument is not itself guaranteed. It is guaranteed by a third party. It is guaranteed by a credit default swaps, and that is where credit derivatives enter the picture of structured finance. In other words, most of credit derivatives are associated with credit default swaps on different types of securitization instruments. Alright, so CDS, which is done by, let me repeat, monoliner or monoline. Again, both are possible. Alright, is this fairly clear? This difference about the guarantees? It's not that they're not guaranteed. They're not guaranteed by the seller. Why would sometimes the seller, let's use another word for the seller, sometimes called the sponsor. Well, why would the seller want to use a non-recourse guarantee? Well, remarkably similar. Your Bear Stearns or former Bear Stearns, what you want to do is you want to dump onto investor a whole bunch of bad paper, and then you don't want to be responsible for it when the paper turns out to be bad. Alright? So that's the basic idea. The basic idea is that by non-recourse, you do transfer the risk. So, non-recourse means risk transfer. Risk transfer. But because there is a sale, there is another very important economic function. And that function is called funding. Funding. In other words, raising funds. Funding, the other word, remember, is financing. In other words, investors here actually come up with money. It might not be their own money, they might have borrowed from somebody else. So hedge fund might borrow from a commercial bank, but they effectively come up with the money and they actually pay to purchase the instrument. So they finance it. in all credit derivatives. Remember, within the credit derivative, there was no actual purchase or sale of the underlying. So there, the underlying was separated from the derivative instruments. Here, you actually buy and sell the underlying itself. And then the credit default swap is a guarantee, which is a derivative on top of the underlying. All right, is that fairly clear? Elementary difference. All right, let's see now. Next concept, where should I go? Let me go over there. Next concept is that of SPV. 7. SPV. SPV stands for Special Purpose Vehicle, also known as SPE, Special Purpose Enterprise. I've explained these a while ago. This is a separate legal entity, separate from the sponsor, with the main objective to separate out both the assets and the liabilities of that particular structure. So the SPE or SPV itself represents the structure. And the idea is to isolate the sponsor from the risks inherent in the structure. That is the idea. The idea is Bear Stearns or Merrill Lynch. If it blows up, Bear Stearns or Merrill Lynch will be sitting pretty and looking smart. All right? So, let's see. Next concept there with an SPV is, let's call it SPV parties. Party as in a legal party, not like a drinking party, right? So, who is number one is seller. So, you have a seller. Seller is the seller of assets to the SPV. Let me see how I'm going to draw this picture over here. Let me try to draw this nice picture over here. So, this represents the structure, SPV, Special Purpose Vehicle. Then you have assets. So, you have Bear Stearns will sell the assets. So, Bear Stearns will be the seller of the assets. Usually, the seller of the assets is also the sponsor. What is the idea of the sponsor? In the most cynical sense, sponsor arranges for the SPV where he can profit immediately from the sale of the assets while dumping, meaning offloading or transferring the risk to somebody else. So the sponsor usually is also the seller of assets. And let's see who else we got. We got also a arranger. And sometimes the sponsor is called the arranger. This is the financial institution which structures the transaction. So, this is the financial institution which structures the transaction. Sometimes the sponsor and the arranger will be one and the same party. Sometimes the sponsor will be a major investment bank, and they will provide a small specialized outfit, a little business, maybe 10 people, who will make all the arrangements on behalf of the sponsor. All right? So the arranger, and then you also have another special party called servicer. So any structure will have underlying assets. These are the debts. These are the mortgages, or these are the loans. Someone must be responsible for servicing these mortgages or for servicing these loans. So a servicer is a third independent institution or a set collection of institutions which will provide for servicing the underlying assets into the structure itself. Alright, let's see what else we have. We have what is called investor. Investor is the buyer or the purchaser of the respective structured notes. So, the investor will actually fund or finance the operation by buying the structured notes. They are expecting certain returns from structured notes. Let's see what else we have. Sometimes, instead of structured notes, we have a very special instrument, which I don't really want to get into the detail of it. It's called credit-linked notes. So, what you should be also familiar is that there is an alternative instrument similar to structured notes called credit-linked notes. And they are associated with credit derivatives and synthetic CDOs. I really don't want to get into the that. So, let me get back to the concept 9 of covenant. So, what is a covenant? A covenant is a rule stipulated in the contract of the structure which provides on how things work. So, covenants are the rules guiding the whole structure altogether. So, covenant could be used the same as rules. Rules is what we call them. Lawyers call them covenants. All right? So, again, structured notes. What determines the structure itself, or structured notes? Number one is the size. So every structured note will have its own size. 1 million, 50 million, 10 million. It may be a retail note, maybe only 1,000, depending. The next one is seniority. I'll be getting a little bit more about seniority. In other words, if a note is senior, it will get first the cash flow. Once the note is fully satisfied with the cash flow as signed by the covenant, only then the next in seniority note will be getting the money. In other words, what you have is super senior, senior, mid-tier, low-tier, etc. The first gets all it was promised, and only then the second gets, and only then the third gets, and it flows to the lower as far as sufficient. So, let me see what else we have. The idea of seniority in size is that it customizes the risk return profile. In other words, every note, by determining its size and determining its seniority, it will be provided with a particular risk and therefore with a particular return within the concepts of portfolio theory by compensating a higher risk instrument with a higher return. All right, so in a nice, 11, let me start in the motion here. It's called seniority, let me see, seniority levels. Seniority levels. Seniority is mostly categorized in two groups. It is called senior and it is called subordinated. So, two notes must be relative to each other. One will be always senior and the other one will be always subordinated. It simply means that the subordinated gets no cash flow, no return, unless and until the senior is satisfied in full. As simple as that. Alright? So, let me try to see how I'm going to do this. I'm going to wipe this off and show you a little schematic picture. So the schematic picture looks like this. We call this the pool of assets, and the pool of assets create the structure. At the top will be what we might call super senior. Once you get the super senior, you get senior 1. Once you pay down senior 1, meaning paid in full, you get to senior 2. There is a possibility of senior, let me just put this nice mathematical letter, senior K. Could be second, third, fourth, senior, and so forth. Then, of course, you get subordinated 1, subordinated 2, maybe a few more, and at the very bottom you get what is called the equity. The equity. Now, each of these is called a tranche. So, this is one tranche, this is a second tranche, etc. These here are called the, up to the seniors, will be called senior tranches. The idea of senior are likely that they're all going to be paid in full throughout the lifetime of the structure. Those in the middle are called mezzanine. Mezzanine. I don't remember how many N's, I don't see it in the textbook right now. Mezzanine, which in finance is typically, and by Wall Street slang, is simply shortened by mezz. By mezz. Okay? And this one is simply called the equity. Let me try if I can remember, there was another name for it. Yes, the other name for it is called credit enhancer. Credit enhancer. So credit enhancer is what is known as, besides, let me try to do this here, this is known as the equity tranche. So, these are the senior. Senior level will have a number of tranches, 2, 3, 4, 5, maybe more. Then the mezz or mezzanine will have a whole bunch of them, 2, 3, 5 or more. And finally, you're going to have a credit enhancer, which is a credit enhancement tranche, and it will be popularly known as the equity. So, what is a credit enhancer? Its related concept is that of first loss. So there are two ways to think about it, which are, of course, mathematically identical and logically identical. The first way to think about it, money comes in from whatever mortgage, interest payments, blah, 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 and the super senior gets paid first. Of course, the super senior may be 20% of the whole structure. So, as the structure collects maybe 98% of all the money, then the second portion will satisfy, the next 20% will satisfy this senior. Then it will satisfy this, then this one, and so forth. And maybe if the money reaches or suffices up to this point, all of the seniors and mezz tranches will get their money in full, and the equity tranche will get maybe 20, 30, or 50%. The logic, of course, is mathematically identical to say, okay, this is what we were supposed to get paid. The first loss is the money that we are not getting paid. They will be absorbed by, let me see, first, will be absorbed by the equity tranche. Alright? The idea is that the larger the equity tranche, the better is the overall, what's called resilience, I'll be explaining it, of the others. In other words, the bigger the equity tranche, the higher the losses the structure can incur, and without damaging the mezzanine in the senior structures. So if you have 10% equity tranche, in other words, the equity is 10% of the whole structure, then you're going to be sustaining losses in the mezzanine tranche only if losses exceed 10%. Alright, is that very clear? Does that make sense? Alright, so this function of the equity tranche to absorb losses without incurring any losses and maintaining these safe is called credit enhancement. Credit enhancement. The mere fact that you have maybe 7% losses throughout the whole structure, but you concentrate the losses on the enhancer, means that the others will not be absorbing losses. So the larger the enhancer, the better or the stronger, we call them in finance, the more resilient the other tranches. Alright, is that fairly clear? Alright, let's see what other concepts do I have.
I have a question. Can you actually invest in this, like in equity?
Yes, not only me, usually, now there are two ways to go about it. First of all, as a general Wall Street rule, the investment bank, or what we call the sponsor, or also the arranger, will take the equity tranche as a guarantee that the others will be performing well. So, if the sponsor buys this out, it will certainly be providing more confidence into it. That's number one. Number two, this can vary extremely extremely high losses, right? So you may actually have the equity tranche to be barely 2% of the whole structure. So overall, this will be a tiny little slice which will be providing an extraordinary return, like 40%. So the smaller this little slice, the higher will be, of course, the return. It will be providing 40% return if there is any cash left over to satisfy after satisfying all senior to it tranches. So sometimes you will have greedy hedge funds which will eagerly devour these 40% returns, hoping that after sustaining the losses, they will be still making above the average. They say, oh, we can still absorb 30% loss and still, based on a 40% return, make a 10% return, which is, in hedge funds terminology, a good return. Especially when you leverage it up a couple of times, right? You leverage up 5 times, suddenly it becomes a 50% return. Alright? So usually hedge funds will be typical buyers, very highly risky other players, but if not, it is considered an act of good faith that the bankers, meaning sponsors of the whole structure, will itself be absorbing the first losses. Questions?
Can you actually hedge with some of the other tranches?
No, no. You cannot hedge with the other tranches. It's the other way around. This is the one that is used to hedge the others. So this provides the guarantee for this one. The others cannot provide the guarantee for this one. Alright? Now, how else? Let me now, I'll do the following trick here, which I can afford to do, is actually enter in another player, and the other player will be a monoliner. Monoliner will be writing or generating, creating an instrument which, as you know, called credit default swap. So the monoliner would love to have a credit default swap on the super senior and provide a guarantee. Why? It's extremely unlikely that 90% of the structure will blow up in order to damage the super senior. So it will provide the guarantee on the super senior is for the monoliner a free money, right? Because it's extremely unlikely that it will ever get to paying up for damaging here. Then it will provide a second guarantee. Then it will provide a third guarantee. Providing guarantees with CDS, providing guarantees all the way down to the equity tranche itself, excluding the equity tranche. So, as a general rule, monoliners will not be providing any guarantees to the equity tranche. That's how it works. Of course, they will be providing to the most subordinated right above the equity tranche, but it will be extremely expensive. Okay, the guarantee here is extremely expensive. So sometimes it will be so expensive that the investor will say, well, I'd rather just take the whole return and not pay up for the credit default swap, because the credit default swap can, the cost may rise 5, 6, 8, 10%. So if the whole return is 16%, and the credit default swap costs 10% to ensure this fairly risky tranche, the investor says, well, do I want to have a 6% guaranteed, or do I want to have a 16% risky? And again, it depends on the risk-return profile of the investor. Alright? So, you got a monoliner is another player there. So, let me go back and write out as a another player, monoliner. And this little piece here is the justification of all the credit derivative lectures that we had so far, because you have to understand how and why credit derivatives work. So, monoliner, and let me wipe these off here to introduce one more player, instrumental in this whole fiasco, and that next player is called credit rating agencies. So, monoliner provides a CDS, and then you get credit rating agency, and the credit rating agency will be providing credit ratings. And what are the credit ratings? Well, let me put in here a little arrow, and the credit rating agency will say what? Here. Triple A. A. What's going to say here? Triple A, of course. Triple A. A again. And then move on, and all seniors, they're simply going to call them triple A. And then when they get to subordinated, they're going to say, well, maybe not triple A, how about double A? Alright? And then how about single A? Alright? And somewhere at the bottom, they're going to say B. They will make them, nevertheless, investment grade. Why would they make all of them investment grade except the last one? Because investment grade sells better. They can stick it to a pension fund, right? They can stick it to a university endowment, all right? And number two, why would they always go down to BBB? The answer is because of the design of the structure. The equity will be always large enough and just barely large enough to make the next one BBB. Alright? So, whatever is necessary to make the equity, they will make it. If necessary 1%, if necessary 2%, if necessary 5%, but the next tranche will be BBB. Alright? We call it triple B. Alright? Questions?
Are those agencies controlled by the state or are they private?
They are what we call quasi-government. They are technically private, but they have the protection of the government. No one may possibly compete with them because the government says that if you're going to be a credit rating agency, you must get a permission by the government, and you must be licensed by the government. And guess what? For many decades, they have been exactly 3 rating agencies, and the government has never ever licensed a 4th credit rating agencies. So, the credit rating agencies are a classic oligopoly, not subject to market competition, and therefore not subject to market discipline. So, no matter how terrible they are, they never face a competition. Therefore, they have no incentive to perform well and to deliver a good product. What is the good product? The quality of their credit rating. So when they say BBB, it would mean BBB. Alright? So, that's number one. Now, being, protected by the government also provides a different wrong incentives because they were paid, if you would remember, by the investment bank. In other words, by the sponsor. And if they're getting paid for their credit rating by the sponsor, they have the perverse incentive of boosting the ratings above and beyond what they are. Okay? Number 3, credit rating agencies weren't ever really experts in these. So what they did was they would receive the model of the sponsor. They will check through the model. Of course, it's a little Excel file which provides stress testing. And they say, okay, it looks good, so it's AA. That's the end of it. In other words, the way they operated in real life was by rubber stamping. They received whatever the model and structure was. The sponsor said what the credit ratings are, and they put a stamp on it and said, yes, that's what it is. Of course, they didn't care too much about the quality because they were not paid on the quality. They were paid by the seller to provide the pricing, and whether it was good or bad, it didn't matter for them. They already got paid. In other words, their pay was not based on their performance. It was based on the willingness to put a stamp on it and provide the corresponding rating. Is that fairly clear? So it provided wrong incentives to them. All right, let's see now. Subordination level. What was the level that I reached here? Was it 13, 12, 13? 12. So let's pull it 13. Subordination level. So the subordination level tells you how much loss the specific tranche, the structure can sustain without damaging the tranche. So if this tranche is 20%, its subordination level is 80%. In other words, the structure can suffer an 80% loss and it will not damage this one. If this one is 15%, then it has 20 and 30 and 15, 35. So the subordination level is 65%. All right. So usually, if the expected level is 95% for the structure, usually they will provide for the equity 5%, expecting that the equity over the long term will absorb all the losses and will not negatively affect the rest of the structure. So this is the subordination level. The way it is called is, the definition is the amount of subordinated notes that protect the particular senior note. Let's see now, scale of seniority, credit enhancer. Alright, the concept is, which I have been explaining and is known in the literature as the waterfall of losses. Waterfall of losses simply says that if there is a first loss, it will be absorbed by the equity tranche, and then if there is an extra loss, it will be absorbed by the next tranche. In other words, losses will first accrue to the first layer. Once it's completely full and absorbed all losses, it will move to the next layer, and then it will move to the next layer and next layer. And the process of flowing losses from a junior, sometimes these subordinated are also called junior tranches, to more senior tranches, is called the waterfall of losses. Alright? So the waterfall of losses is the mirror image of the water flow of cash flows. In other words, when the cash flows flow from the senior to less subordinated is identical to losses flowing the other way around. Alright, so let's see what else we have. Alright, all of these notes have a special name. Overall, they're called classes of classes of structured notes. So all of these are simply called classes. So this will represent the senior class. This will represent from here to here will represent the mezzanine class. And this will of course represent the equity. Alright, so they're just called classes. Let's see what else we have. Amortization schemes. I don't want to go into that. Alright, the next concept which I have mentioned is called resiliency. Resiliency of a structure or resiliency of a particular class of structured notes is associated with its ability to sustain a large variation of losses without actually incurring losses for the particular class. So, let me try to see how we call it. So, the ability to sustain large variation in risk drivers, let's call this next term risk drivers. So, a large variability of risk drivers without damaging the return of the particular class. So, what is a risk driver? This is a particular variable, could be macroeconomic variable, some other variable that changes the materialization of risk. For example, a classic risk driver will be rising interest rates. Rising interest rates will make harder mortgages to be refinanced. So, when interest rates rise dramatically, it will result in higher delinquency of mortgages, of credit-linked notes, of credit cards, etc. And this is an example of a risk driver. The most classic example of all of risk drivers is economic recession. When the economy slips into a recession, it drives the risk to be much higher, actually the materialization of risk. So, as risk drivers change the economy into a recession, you get respectively different levels, and how well the structure can absorb losses will depend. How much time we got, guys? 10 minutes? 15 minutes. Alright, let's see what else. So, let me probably just wipe this off and move on to see what might be factors in a resilience. In other words, what determines the resilience? All right, let's see. Number one. Again, 15. I'm repeating it. Resiliency. All right, number one is called delinquency rate. So, this is the percentage of delinquencies in the structure. Delinquency is a certain level of default where people have not paid for a particular period of time, maybe 30 days or more. So, if the borrower is behind more than 30 days, the borrower is considered delinquent. So, whether the delinquency rate is 1% or 5% makes a major difference for the structure. If the equity tranche is 3%, 1% delinquency means that all delinquencies can be absorbed by the equity tranche, and it will not flow over, losses will not flow over to higher rates. Now, just because delinquency rate may rise doesn't mean that losses themselves will be higher. So, the next the next variable that determines the resiliency is called the charge-off rate. Charge-off. Again, a loan goes into a default. It does not mean that you're going to write off the full amount of the loan. Why? It may be a car, and the car may be on a lease, for example. So, if the car is on a lease or general car loan, and the mortgager borrowed 15, the outstanding in the third year was $10,000, and the borrower defaults, the lender may actually repossess the car, sell it out on an auction, and get $7,000. So, in this particular case, you get a recovery of 7,000 out of 10,000. So, the charge-off rate will go hand in hand with a recovery rate. So, the recovery rate essentially tells you, based on the write-off, based on the default amount, what percentage of that amount of the outstanding on which the borrower defaults, the lender will be actually able to recover after the proper legal procedure. So in my case, what I had in mind was, out of 10,000, the lender recovers 7,000, and it must charge off 3,000. So the recovery rate in this particular case was, the charge-off rate was 30%, and they were able to recover 70%. Of course, I must add, either reduce from the recovery or add to the charge-off rate the administrative cost of enforcing repossession and liquidation. So legal cost must be somewhere factored in. Now, you also have, let me put it in there, the concept of overcollateralization. Collateralization. So the house is worth 100,000, and you provide a loan of 80,000. On a basis of 80,000, you have an extra margin of safety, or the collateral is 25% more. So from 80,000, you have 20,000 more, so that's 25% over collateralization. So the collateralization rate is 125%. All right? The over-collateralization is exact opposite of LTV, loan to value. In other words, if the LTV is 100%, there is no over-collateralization. If the loan-to-value is, let's say, 80%, the 1/80% over-collateralization will be 25%. If the loan-to-value is 50%, then the over-collateralization will be double, or 100%. So, the lower loan-to-value ratio, the higher the over-collateralization, and eventually this implies a higher recovery rate, and therefore a higher resiliency of the structure. So each of these factors determine the overall resiliency of the structure. Let's see what else we have. Okay, not very many things. We get to the basic topic of economics securitization, which is the basic question of why would financial institutions, investment banks do that. And there's a whole bunch of reasons. Let's try number one, which is better risk return profile. Because the structure itself is designed by people, they can fine-tune it exactly the way the customer wants it. So they can literally tailor any type of risk return profile within the subject of the market. So this is rationale, economic rationale number 1 for doing it. Rationale number 2 for doing it is that of cost of funding. Cost of funding could be determined by the financial institution or sponsor. In other words, the sponsor himself, Merrill Lynch or Bear Stearns, might be financing it, and if they found financing it, they have a particular cost of capital. Cost of capital. The most widely recognized and the most appropriate measure is called, what is this, guys? Weighted average cost of capital. And weighted average cost of capital is the weighted average of the cost that the financial institution must pay to finance itself. In other words, the return on each of the liabilities of the financial institution will be weighted with its appropriate weight, and it will provide the cost of funding for the Merrill Lynch, all right? And the other one will be, of course, for the structured notes. So, the idea is that it makes economic sense to separate out the assets if the structure may be financed in a cheaper way with structured notes than with weighted average cost of capital. So usually structured notes pay a little bit less, all right? Well, the difference between the cost in structured notes, in other words, you have certain assets, and in one you must use the weighted average cost of capital to compute the present value of these assets, and then with the structured notes, the difference between these two returns will be effectively pocketed by the financial institution. So if it costs financial institution to finance it itself by 7%, but it could use the market to finance it by 5%, the financial institution, by selling it to the structure, will be able to pocket the 2% differential in the one cost and in the other cost. The present value of these two cost differential, it will pocket by itself. Essentially, it is relying either on better financing from the market, or it is relying on mispricing by the market. Okay? It is one or the other. And there is one last concept called regulatory arbitrage. Regulatory arbitrage simply says that there must be capital set aside if the Merrill Lynch will keep. If the Merrill Lynch will keep the assets on its balance sheet, they are risky assets, mortgages, car loans, whatever. They must set aside appropriate capital. However, if they sell it to the structure, they will not have to set aside the capital to absorb losses. So, even though the financing may be the same, in other words, even though the weighted average cost of capital might be identical, if they sell it to the structure, they don't have to put aside the capital. Well, who should then put aside the capital? Well, the answer is whoever will be absorbing the losses. In other words, the monoliner then would be responsible to put aside the capital. Well, we know now that the monoliners did not set aside the capital. In other words, it was a procedure through which there has been a risk and nobody is effectively providing capital for losses. In other words, it allows to undercapitalize the structure because the regulation does not require any capitalization of a structure. So that's one of the key rationales is, oh, if we move it over there, we don't have to set aside capital. Nobody has to set aside capital. Okay, let's see what else I have. I'm pretty much done. Yeah, I'm pretty much done. So everything I had, I have been able to cover for today. Any questions, guys? Let's see any type of questions. Any? None? All right, then we're done.